All right, so everybody knows the credit score and how important it is to have a good credit score when you're looking to purchase a home loan. Well, what people forget is your debt to income ratio is another key factor that the lender uses to see how much you qualify for. What's the debt to income ratio? The debt to income ratio is your gross amount pre-tax that you take home. So if you bring home $5,000, all your debt within that divided into it will give you a percentage, and that is your debt to income ratio. With our example that we're going to use today is a conventional loan. A conventional loan tends to have about a 45% max debt to income ratio, DTI. So let's calculate this one. So say if you have a car and that's a car note, you got your credit card, which all the minimum balance, no matter how much you owe on your credit cards, only the monthly minimum balance is going to factor into your debt to income. For example, we're going to keep the numbers clean. 5,000 bring home, 500 for a car, 500 for the credit card. That is $1,000 eaten into that $5,000, allowing you to have a 20% DTI. Remember, I said for a conventional, 45% max. So how much money can you afford for a mortgage to keep that DTI under 45%? I'm calculating in my head, so hold on. So it comes to $2,225. That is how much you can afford for a mortgage. And depending on the lender, they're gonna factor in the interest, the principal, the HOA, the taxes, all of that. Now, depending on where you're looking to purchase a home and all of that good stuff that's coincide with the mortgage to go against your DTIs, make sure you can afford it. You're gonna get a good idea of what you really can afford and what the lender is gonna approve you for. All right, so I hope that helped. If you have any questions, you know how to find me. Thanks.